A very good morning, ladies and gentlemen. Thank you for joining us for this derivatives markets webinar hosted by the Nigeria Exchange. I'm Wale Famero. I'm delighted to be moderating today's program. And it is a very important next steps to the introduction of derivatives. And by derivatives, I'm talking specifically about single stock futures, which will be a big focus of today's conversation. So you're all welcome. Thank you again for joining us. Just some very quick housekeeping to get through. We look forward to having you chime in and share your thoughts. So as you do so, I want to encourage you all to use the Q&A field to type in your questions and comments. And at the appropriate time, we look forward to taking those questions and comments. And just to give a sense of what the format of today's engagement, very shortly, I'll be introducing the Executive Director, Capital Markets at the NGX, Mr. Jude Chiemeka, to deliver some welcome address and just to help us set the tone with some opening remarks. And then we'll get right into it with some presentations. The first will be on uncovering trading opportunities in the NGX single stock futures. And then we'll be focusing on risk management and clearing the role of CCPs in the derivatives markets. We'll move on to take your questions regarding those two presentations, and then we would move on to a fireside chat where we'll be looking at adopting single stock futures lessons from other markets. We have a host of very distinguished speakers from across Africa to give us some perspective on that. And then we'll be moving on to a panel session. And the theme of that will be the role of market participants in building a sustainable derivatives market in Nigeria. So that's what we have coming up. And as I mentioned earlier, I would like to now yield this virtual stage to the Executive Director, Capital Markets at the NGX, Mr. Jude Chiemeka, to give some opening remarks. It's over to you, Jude.
Thank you, Wally. Good morning, distinguished ladies and gentlemen. It's indeed my pleasure to welcome you all to this year's NGX Derivatives Market webinar. We are indeed delighted to host this event in collaboration with our esteemed partners, underscoring our unwavering commitment to promoting access to diverse investment opportunities and reinforcing investor confidence within the capital markets. The International Swap and Derivatives Association, ISDA, has reported that over 90% of the world's 500 largest companies across 26 countries strategically employ derivatives to mitigate risk. These financial instruments have become integral in today's dynamic financial and trade markets, offering not only risk protection, but also serving as a catalyst for the development of resilient liquid capital markets, which in turn boost our economic growth. According to the World Federation of Exchanges 2020 derivatives report, the number of exchange-traded derivatives contracts encompassing both options and futures has recently reached its highest in 6 years, totaling an impressive 84.76 billion derivative contracts traded, 56.17 billion for options, and 29.59 billion for futures. This represents a remarkable 34.4% increase compared to 2021. Furthermore, the global derivatives market is poised for significant growth, projected to reach $39.17 billion by 2027, up from $21.98 billion in 2020, with a compound annual growth rate of 8.6%. This remarkable growth is underpinned by product and technology innovations driven by exchanges, intermediary firms, and related service providers worldwide. As you may be aware, NGX made a pivotal moment in the financial industry when it launched West Africa's first exchange-traded derivatives market in April 2022, commencing with equity index futures contracts based on highly esteemed NGX 30 index, as well as the NGX pension index. This endeavor aimed at diversifying investment avenues, enabling efficient risk management, and facilitating investment strategies across all diverse assets and financial instruments. Today's webinar, themed Uncovering Trading Opportunities in NGX Single Stock Futures, is crafted to ignite meaningful conversations and foster a deeper understanding of single stock futures contracts and their practical applications in investment. Moreover, it serves as an opportunity to inform market stakeholders about NGX single stock futures product launch. The exchange takes immense pleasure in hosting today's event, acknowledging the pivotal role of capacity building and investor education in the development of this asset class. I wish to express our heartfelt gratitude to our esteemed sponsors, APT Securities and Funds Limited, Park Securities Limited, and RMB Nigerian Stockbrokers Limited for their invaluable support. We also extend our deepest appreciation to our distinguished guest speakers and panelists who bring a wealth of experience in managing this asset class. In closing, I extend a sincere welcome to all participants in this webinar, and I'm confident that the insights gleaned from today's discourse will kindle a renewed interest in the NGX derivatives market. We are committed to providing a platform to you and your clients in achieving your investment and business objectives as integral stakeholders in the Nigerian capital markets. Thank you very much. Wole, over to you.
Thank you very much, Jude, for setting the tone. And I want to echo the sentiments by thanking our sponsors and partners for making today's event happen. We're going to jump right into the crux of the matter as we begin with our first presentation today. And that will be on uncovering trading opportunities in NGX single stock futures. And to deliver that presentation, I'm delighted to invite to this virtual stage the CEO of Page Investment Managers, Mr. Gabriel Olumide Odediran. It's over to you, Gabriel.
Thank you. Good morning, all. I hope you can hear and see me clearly. My name is Gabriel Olumide Odediran. I'll just jump straight in to the presentation and we'll take it from there. Let me share my screen quickly. I hope you can all see the screen and the presentation.
Yes, we can. If you can just switch it to presentation mode, that would be great.
Okay. A moment. All right. So what I'll be doing is giving a brief insight into the trading opportunities single stock futures could offer investors and participants alike on the NGX exchange. I'll start just giving a brief background of myself so you understand where I'm coming from. A nice basic intro into single stock futures, as they're one of the actual most straightforward and simplest derivative instruments out there to understand. And I'll touch on some of the different opportunities and characteristics that these instruments offer. Then I'll just finish off with the anecdotal case study of how and what it could be used for and things it could really help mitigate. So as I've been introduced already, my name is Gabriel Olumide Odediran, and I am CEO of Page Investment Managers, one of the business brands of Page. My experience spans across many years, across different asset classes, working with several big institutions in the UK and in Nigeria. I've pretty much done all different asset classes, the key ones: bonds, equities, derivatives. So I have a wealth background. Again, my education speaks to some of this. All right, so single stock futures, like most other future contracts, are basically contracts that oblige buyers and sellers to execute at a predetermined price in the future. So they basically go into a contract saying, I'm going to exchange for cash in receipt of a security at maturity, a security. On the futures, they're really standardized, and the standardizing of it makes it easy and seamless to trade back and forth between buyers and sellers. One of the main characteristics is, it's quite straightforward that it mimics quite closely what this underlying stock it's referencing does. So as the stock goes up in value, so does the future. As the stock goes down in value, so does the future. It allows you to then, build a nice relationship. So people that want to take a long position or buy the futures know that if the future price rises, they make money. If it falls, they lose money. And people that want to take the opposing side, who would maybe want to bet that actually the price is going to fall, would benefit as the price drops and obviously lose as the price rises. And it's important to understand this basic and straightforward logic, because single futures in themselves, offer investors a margin type account or benefit. The characteristics is you don't need to put up all the money to get the same exposure as you would to the stock. So herein lies the different opportunities they offer. They offer you, they allow you to be able to leverage your returns, so you could significantly augment the type of return you get. So, for instance, I've got 4% on the stock if you bought the stock, but the futures would then allow you to augment it with efficiencies of capital to, let's say, 50% or more. You could speculate, again, as all financial instruments, you could take a view, I think it's going to go up or down in price, and you put that view down by taking either a position where you're buying the futures or you're selling the futures, which is shorting it, selling it without owning it. Again, a lot of transactions that go around in the world, especially with derivatives, are usually for hedging purposes, to protect the value of their security or their investments. Again, they're protecting against uncertain times, volatility in price, maybe macro pictures is gone all over the place, the world is uncertain, and to that degree, investors are uncertain about how the outlook is going to look, and they see volatility in price, and they don't want to experience that volatility. They use the future instruments to hedge, or other derivative instruments to hedge and protect themselves at times like this. Other people use it for pairs trading, which is they say stock A and stock B have this relationship. They're maybe both in the same sector and they both move in the same direction as prices go up and down to certain degrees. And some of them use to see if the relation breaks down in short periods. They take advantage of that breakdown correlation with the assumption that correlation will return to then buy one and sell the other, with the idea that correlation will return and the price will revert back to normal. The other type of advantage or characteristics or opportunity using single stock futures would be efficient use of capital. So you, for instance, want to buy your Dangote or your GTB at a certain price, but the cash that you're expecting to receive from investors is not coming for another month or two. You could, for smaller amounts of cash, get into a futures contract that will allow you to get that exposure now. The idea is you will not want to miss out on opportunities that may happen in that month. The price may be rising and you have a good view that there's going to be appreciation in price, but the cash you have is not ready. So to that degree, the future contracts then offers you that option or opportunity to get involved in the market with a smaller amount of cash, a smaller amount of capital. So let me just again highlight again to the right. You can see the overall position value you can get an exposure to for a small amount of margin put down. So I've stylized and put down how different instruments in the market. For instance, you've got the S&P 500. That margin factor, you don't even need to put 1% of your position, of the position you want to get exposure to get it. Similarly, at the bottom end, I've shown Tesla and BA Systems. So all of these products have been, the underlying instruments have been turned into future contracts or different type of margin type products that allow people to get involved for a significant amount of capital. This allows a huge base of investors to get involved. Now, with all margin products, you have to put up margin, and you also have to maintain your position. So you need a bit of extra cash on the side to maintain and have that position maintained as prices go up and down. So let me just jump into one clear stylized example. Again, I've simplified it to understand how it works. So from the point of leverage, for instance, if I wanted to buy 1 million shares of GTB at a price of 25 back in the days, I'd have had to put 25 million naira down. And then at the end of the period, when I want to exit it, I sell it for 30 naira and I make 20%. For the same type of structure, you could have bought your single stock future, getting the same kind of similar exposure, but only need 20% margin factor for that position. And your return on that margin itself would have been 100%. So it stylizes and shows you how you can augment your return or, leverage your return. But this cut both ways. So the same hand that gives you the benefit can also give you the slap, which is you can lose 100% as well the other direction. So this is, an instrument you would have to understand how it works, prepare for liquidity, manage your risk appropriately. Obviously, it can be used for hedging as well. So an example would be you have 1 million shares of GTB at 25 back in the days. You could have gone short, which is taking the opposing view using single stock futures, struck at the price of 25, and the capital outlay would have been significantly less. And if GTB had dropped to 20, the portfolio loss would have been insulated by the gain in the single stock futures, and it would have protected your capital per se. And you could have been going through a volatile period, but you still wanted to hold GTB for the dividend it would pay. So that dividend that is being paid is actually, a strategy people utilize to hedge themselves during time of uncertainty, but in dividend-paying names. So that's one good function it offers. The other one we can really look at would be stylized. How efficient do single stock futures allow you to maintain your portfolio? So let's assume you had 25 million to spend overall, and you're going to utilize every single drop of it. How could you really, make it more efficient for the exposure you have? So the first example would be just buy GTB shares straight out. 25 million as an outlay in both in an up scenario and down scenario. You make 20% or you lose 20%. Similarly, on the single stock futures, you would only put 5 million down. You would make 100% on the 5 million or lose 100% on the 5 million, depending on your exit price. However, if we now say you now have the remaining 20 million to utilize with the single stock future, you would put some on the side to deal with variation margin, which is as the price moves up and down of the security, you need to maintain that position. So you've allocated another 20% to deal with that. Then you have some excess cash on the side, the remaining 60%, 15 million. What can you do with that? You say, okay, let me find someone or some instruments I feel comfortable with that I can pop the money in and let it increase and earn yield, knowing that it's still part of the overall portfolio. In the two scenarios we talked about, one would then augment your return from 20 to 26 for overall 25 million spent, and the other scenario where it loses out, it will reduce your loss by 6% to 14%. So again, it can be used again like any instruments in this world. It's in the hand of the beholder, which is you can use it very well if you know what you're doing and what your objective and your outcome is to augment your return, to reduce your risk, to insulate your portfolio, to still allow you to get beneficial returns in the instrument you're going into. So in finishing, what I just want to do is just really go through what really happens when, for instance, when I buy and sell stuff, and when many of the investors that I've worked with have gone through buying and selling stuff through time, and I put them in two camps. Ones that have options of a plan A, B, and C, and ones that just have options of plan A or plan B. So someone that buys a stock normally would have an idea of buying it. I think it's going to go up for reasons X, Y, and Z. You buy it for growth of the company, and you believe it's going somewhere. However, in the future, things happen. not everything is in one direction. Only God knows the future. Sometimes things happen. And at that point is the time you would really, really need options to what can I do? Do I sell? Do I hold? Do I hedge? And those are the options we really don't have in this market. We really box into the corner of, do I hold and suffer the P&L loss and hold it till it recovers, or do I sell it and forego the future dividends or potential recovery? And people go through this, and sometimes, you get to a point where you've gone through the cycle, and it does affect your decision making when you're seeing P&L bleed and you don't have any other options. And I've seen people that have 100% thoughts, yeah, the stock can never go down, it's all going in one direction. All of a sudden, their ego kicks in, they're always right, it starts falling. Now they don't want to sell, but they don't have any other options of what to do to protect themselves. And they end up selling at the bottom. And what really happens with good companies through time, and really good investors will spot this, this becomes opportunity to buy when things fall. But some people would have panicked and dumped their position and gotten out, to eventually realize that things are not always going to be the same way. We go through cycles of good and bad times in life, and same thing with the markets. And this is the cycle that investors really go through emotionally. They get excited, they get the thrill of the chase, and the risk, they really don't see the risk because they believe nothing can go wrong. And then things start changing slowly, they're in denial, anxiety, I don't want to sell, I'm going to hold, it's only going one direction. And then it gets to a stage where, the market and the prices reach their threshold and they get out, only to realize there's a recovery coming on later on. So one of the things that would have helped investors and helps a lot of investors during times of uncertainty is ability to hedge with derivatives. As we said, in life, there's no such thing as a free lunch. However, derivatives is a second best alternative that allows you to diversify, hedge, protect yourself for a cheaper cost. There are many different, there are typical protection strategies out there, and derivatives are really one key center that the world has evolved. They work like insurance product, basically. Would you drive your car knowing that you don't have insurance? No. So derivatives you can think about in that kind of fashion if you're very, very, risk averse. So generally, that's my intro into, understanding single stock futures and the different opportunities they offer. Hopefully we take questions at the end and as we go into the panel discussion. Thank you very much.
Thank you very much, Olumide. No doubt we'll be taking questions. And actually, just so everyone that is participating in this webinar knows, we're going to take another presentation now. And then right after that, we will actually take questions from Olumide. So Olumide, thank you so much for that very interesting presentation. So you can just stand by to take questions in a moment. I really like that slide where you talked about the cycle of emotions. And it just reminded me of that old quote that markets can be very intoxicating on their way up, but very devastating on the way down. So with futures, hopefully you have an opportunity to manage that risk. And speaking of managing risk, I think another takeaway from your presentation, which gave me some food for thought, is that it's not really about predicting the future, it's about managing it. And so to give us some more perspective on how better to manage that future, I'm delighted to now invite to deliver the next presentation, the Managing Director and Chief Executive Officer of NG Clearing Limited. He will be speaking to risk management and clearing, the role of the CCP in the derivatives markets. So no doubt a big focus on risk management. So I'm delighted to yield this stage now to Mr. Farouk Oriagba. So over to you, sir.
Thanks, Wally. Good morning, everyone. Thanks for the invite. Yes, these are definitely interesting times. I hope you can see my slides. I hope you can see the slides.
Not yet.
Hold on.
They aren't up yet, so
Hold on a second. I've got an ID10T error here. Just bear with me a second. Where is this thing? Let me share this thing. I've got my magic man here.
Right. Many thanks to the magic man. Hopefully he gets that sorted out. All right.
Can you see it now?
Not yet. It's not popping up yet.
Everything works until you want it to work.
Well,
Can you see it now?
how do we hedge against this? I guess you'll be telling me.
Can you see it now?
No, unfortunately, not yet. We can't see it yet.
How's that?
Not yet. Still not yet. Okay.
Right.
Great. We can see it now. You can just switch it
Right.
to presentation mode.
Are we good?
Now.
Are we good?
Yes, please go ahead.
Okay. Once again, thanks for the invite. We've had a couple of interesting presentations already, and I think it sort of falls straight into what I want to talk about. Jude mentioned something about 84 billion contracts. Now, if you think about 84 billion leverage contracts being traded annually.
My apologies, Farouk, for jumping in. Do you want to tweak the setting a little bit? It's not, we're not seeing the entire, we're seeing pretty much all the slides. We know what's coming up. I guess it's just the way you have put it up. You'll need to tweak that a bit.
Yeah, 1 second.
You can just...
Right, so while the magic men are preparing what they're doing, we've spoken about 84 billion contracts being traded worldwide. Now, if you think about the kind of participants we've had, people that would participate in that, you have people doing leverage, speculation, hedging, pairs trading, as Olumide said. It's all a very large amount of risk concentration in any one market. And it's essential that these risks are managed carefully, efficiently, and ultimately, for those who can think back, we've had issues in the past where derivatives traders have blown up banks. Go think about Bearings. There was a case of UBS several years ago. So the one entity that is sort of geared to managing risk in derivatives transactions, amongst other roles, is a CCP. And I'd like to just talk about the role of a CCP in the derivatives ecosystem, in derivatives trading, and in particular, obviously, NG clearing. So I just go straight into my presentation. Well, what is a CCP? A CCP is a central clearing counterparty whose role is to manage the risk associated with derivatives trades, ensure efficient settlement of derivatives trades, and to make sure that everybody fulfills their various obligations. Another major part of a CCP is centralized, is offsetting. So if you can imagine, as Jude said, you have 84 billion contracts being traded, different kind of counterparties, speculators, leveragers, hedgers, pairs traders. The role of a CCP that sits in the middle of these transactions is to net off the risk of the various counterparties, which makes for efficient management, efficient settlement, and in effect guarantees the trading. How does it do that? A CCP, like I said, basically is there for risk mitigation. It steps in between, in the middle of every transaction between a buyer and a seller. This process means that the CCP will become the buyer to every seller and the seller to every buyer. It takes on the individual risk, and this process is called novation. Now, the reality of it is, if each side fulfills its obligations, then net there is no risk. And this is the crucial role of a CCP, to make sure that each party fulfills its own side of any trade or obligation that arises as a result of a trade. So novation is what it's called. The CCP takes on each party's risk, assumes counterparty risks, and you could say that it's in its own interest to make sure that the trades settle, because otherwise the onus falls on the CCP. Gabriel, in his presentation, mentioned the ACE of derivatives contracts, which basically means that derivatives allow you to take on significant exposure without having to put the total amount of capital down. Like he pointed out, he showed margin. Margin, in entering into a derivatives trade, each counterparty must put some down some margin to get the overall exposure. Now, the role of a CCP in this transaction is it monitors the margin. So in the case of NG clearing, for example, we have the systems we have here. We have the margin consists of the initial margin, which is pretty well standard. And then our systems calculate an extreme loss margin, which every client on the initiation of a trade must put down, both the initial margin and extreme loss margin. And then on top of that, we'll have the variation margin, which is basically mark to market of each party's P&L on a daily basis. So net, if Farouk and Gabby enter into a trade, well, if Gabby's making $1 million, then Farouk's definitely losing $1 million, or rather, I'd rather go the other way around, but let's not talk about that. So the role of the CCP is to manage this margin, monitor it in real time. In any case, if in any case a client there is a shortfall in a client's margin, there will be a margin call to make sure that that client comes up with the extra collateral required, so that at any one time, neither the CCP nor any of the other parties in the transaction are left exposed. So as a CCP, by setting adequate margin requirements, the CCP tries to ensure that participants have sufficient funds to cover any potential losses that may arise. Hence, making sure the trade's settled. Clearing and settlement. This can be a bit of a contentious issue for a CCP, because a CCP facilitates the clearing and settlement of transactions, but not just in derivatives transactions, but CCPs actually can facilitate the settlement of pure equity transactions. So in this case, we're talking Nigeria. You know, if a CCP was involved in the settlement process, for example, it would even facilitate things like trading and settlement on the same day, instead of T+3. But that's besides the point. As for the sake of this presentation, the CCPs will facilitate the settlement of all derivatives transactions. It ensures that all contractual obligations are fulfilled, transfer of ownership, movement of funds, maintenance of margin. And by doing all this, and if, like I said, if you've got several millions of contracts, or billions, as Jude pointed out, on a very, very large scale, by centralizing and streamlining these processes, you know, the CCP enhances efficiency and reduces operational risk. Risk monitoring and management. Well, like I said, in order to ensure that all margin requirements are being met, that all parties have sufficient margin to cover their exposure at any one particular time, the CCP will need to continuously monitor market activity, assess the risk, continuously assess the volatility. It's only natural. If there's a volatility spike in a market, you can expect you know, the margin, the amount of margin required to go up. The CCP has to continuously monitor this and monitor the participants' positions. We don't do this on the back of a matchstick. We have pretty robust systems and methodologies which the clever boys in the other room they put together, and taking into consideration all the eventualities to calculate potential risk based on volatilities. So at any one time, they can estimate what the margin requirement should be, and then this they then go out to ensure that all parties fulfill these margin requirements. The reason why it has to be monitored continuously, because the last thing you want is for there to be a spike or a declaration of war midday, and the market moves, becomes very volatile, and there's a guy who's caught offside. It's no use going back to that person at the end of the day and said, "Oh, sorry, sir, you need to give us $10 million." It's important that it is monitored continuously. So before the events or the negative exposure arises, the margin calls are put in place and the funds are made available. If not, the positions get closed. So it's very important to make sure monitoring is done on a continuous basis. In the unlikely event of a default, as I mentioned, bearings happened before, and there's been one or two others, but we try not to make them happen often. But in the event of a default, any CCP has contingency plans to manage the situation. It is also, the reason for this is the CCP has to maintain the sanctity of the environment in which it's operating, so the market, so to speak. On one of the other slides, I'll show you how it works. But participants in the market make a small contribution, and there is a default fund. And this default fund, and then there's a process attached to it, is there to make sure that irrespective of what happens, all contractual obligations are fulfilled. And this is one of the reasons why CCPs are so crucial, because you're looking at people leveraging significantly, taking on significant risk, both speculators, hedgers, pairs, just general market traders. And each one's got a different appetite for a different pay threshold and a different appetite for risk. And the CCP has to take all these into consideration. Gabriel spoke about he showed us a graph about some emotional cycle. These are the kind of things that we have to take into consideration to make sure that even though a client may think that the position may turn around and he'll make money, we can't afford to wait for that, because that's putting the market at risk. So we have to make those margin calls. But in the event that they fail to fulfill any particular obligation, there is a waterfall structure which shows how the funds in the event of a default are made good. So at any one time, no trades fail. Here we have the default waterfall. So if a trade does fail, the first part to go will be the defaulter's initial margin, and for the trade, which they have to put down. Over and beyond that, there will be a call on the full amount that the defaulter has contributed to the default fund over a period of time. If the losses exceed that, NG Clearing, who is also a contributor to the default fund, the company we work for, is a contributor to the default fund, will also have to come up with a portion of the losses. So not only is the CCP a facilitator, but the CCP always has skin in the game. On any transaction, the CCP has skin in the game, which is also, it helps focus the mind a little bit. If there are any more losses beyond that, then the CCP will have to call on some of the contributions from the non-defaulted members who have also contributed to the default fund. And if there is still an excess after that, any further losses will be covered by way of pro rata haircut to the payer, just to make sure that the trade does get settled and all parties are made good. Over and beyond what we're speaking about, the role of CCPs, just moving on a little bit, have other roles. So they're not just here for derivatives trading, they play significant roles. As I've put up here, derivatives trading and clearing, but there are other transactions where CCPs can add value and do add value. So such as securities lending, cash commodity trading, cash equity trading. As Gabby sort of mentions, you have a situation where you got cash equity traders, or even those doing cash equitization. CCPs play a role because they are in a position to ensure that both sides sort of, meet their contractual obligations. In cash equity trading, for example, on a normal cash equity trade where you settle T+3, the reality is if a CCP was part of that transaction, you could actually settle T+0, because the minute the cash hits the trading member's account and the collateral on the securities hit the other party's account, there's no point waiting for another 2 days. If both sides have delivered their sides to the obligation, the trades can settle. So even T+0 is possible with a CCP in the mix. Another kind of transaction that CCPs play a role in are swaps. I mean, we've already seen a lot of foreign exchange swaps being done. CCPs play a role in that, even in Nigeria as we speak, and hopefully we'll see a lot more of that. So as a CCP, it plays a significant role in financial market integrity. CCPs are classed as financial market infrastructure companies. They're just not limited to derivatives trading, but as far as derivatives trading is concerned, and for the purpose of this webinar, they do play a crucial role. Thank you very much. I'll take questions whenever. Thank you.
Thank you very much, Farouk. And we certainly look forward to speaking to you, hearing from you again as we take questions. But in the interest of time, I probably would just ask you one question for now, and then hopefully we can take some more later. I want to thank all our participants that have already dropped some questions, but I think this is one question that perhaps would be valuable to everyone. And that is, can an individual trade in the derivatives markets that we are constructing right now? Or is this just an arena for institutional investors? Because as you know, individual investors have been trading in stocks in Nigeria for many, many years. So is that about to change in the context of derivatives? Are there any, can you just give some guidance on that?
Okay. The answer, a typical derivatives market consists of a variety of participants. Like I said, you have the speculators. The speculators actually tend to be individuals. And that's the benefit. And that is actually one of the key selling points of single stock futures that we're talking about. You can get exposure to the same number of shares without having to put the full amount down. Gabby made the example in GTB. However, it's also very important that individuals realize that if the losses do arise, they can actually exceed the amount of money they put down. If the CCP doesn't do its job properly, the speculator individuals could end up losing more. And that's why the role of the CCP is so important. Now, in most climes, you'll find out that if you're an individual and you want to trade in the derivatives market, you'll have to sign what is called a risk warning notice. A risk warning notice is to say, listen, I know I can lose my house, I can lose my shirt, I can lose everything. I am aware. So if I do lose my money, please, if you lose your money, don't come and start crying that you didn't know what you're talking about, because they're purely, you need to be an educated investor. And in some cases, I'll just finish with this, in some countries, but not in Nigeria, in some countries, they won't even allow individuals to trade derivatives because of the risk. But for Nigerian purposes, yes, we will be able to, individuals can trade these single stock options, and we look forward to welcome them aboard.
Right, but are there any guidelines, or would those be delivered later?
The guidelines, when you sign up, the way the market is structured, the clearinghouse it onboards the general clearing members. So there's a chain. So you go from your stockbroker signs up with a clearing member who signs up with the exchange. The clearing members are banks. That's how we can move money in and out of your account without you can't turn around and say you don't have money. We move straight and take the money. So the guidelines, we at the moment NG Clearing has onboarded. I'm using my employer as an example. We've onboarded several clearing members. In terms of the trading members, who are the stockbrokers, really, what you call stockbrokers, we call them trading members. We have about 18 in the pipeline. NGX will be in a better position to confirm the number, but there's about 18 in the pipeline looking to be onboarded. And then once those 18 onboarded, the individual can go to their stockbroker to decide and to trade these single stock futures. On our part, NG Clearing produces on a daily basis updates. We put the market prices out, daily market prices of the futures. We've had a lot of inquiries from both individuals and other potential trading members that, oh, what else can you tell us about this? So what we've also realized is there still needs to be a bit of enlightenment to happen. And I know for a fact the NGX and NG Clearing and some of the other exchanges are planning some enlightenment amongst the participants. But ultimately, for the individuals, it's the stockbroker that's going to guide them, because that's their interface. So client to stockbroker, stockbroker to clearing member to us. So, but yes, there will be more guidelines coming out and more training.
Thank you very much. Obviously, this is evolving, and we'll get more details as we proceed. Thank you so much for that.
You're welcome.
All right, we'd like to now move on to the next segment of today's program, which is a fireside chat, and we'll be getting some perspective from outside the country, those who have gone ahead of us in this whole business of single stocks futures. And I would like to now invite the moderator of that session, and she would be introducing the speakers, and she's none other than Chidima Chukwueke Okolo, Head Products Developments at NGX. Chidima, it's over to you.
All right, thank you very much, Wole, and good morning, everybody on the call. I'd just like to introduce this session. So this session, we're really looking at a chat with some other experienced exchanges around the adoption of single stock futures and the lessons we can learn from them. I have with me Mr. Justice Ogalo. He's a derivatives manager at Nairobi Securities Exchange. And I also have Ms. Gabo Molabe. She's a structured products specialist, capital markets at the Johannesburg Stock Exchange. And we hope, are they on the call? Yes. And we hope for this session really is to understand their growth story, the adoption of the product, the challenges and successes, and most importantly, the kind of lessons that we can learn. So Justice, welcome. And I'll start with you. Let's start with the Nairobi Stock Exchange and the Kenyan story. Can you share with us the beginnings of the derivatives market in Kenya? You know, when, what products you launched with, and what hurdles you needed to jump to kind of launch the market?
All right, thank you, and good morning, everyone, from wherever you are. For me, it's the afternoon, but thank you very much to the NGX for having us for this discussion here today. So to give a brief history into the journey of the Nairobi Securities Exchange into the derivatives market, we launched our derivative exchange in 2019. And when we did launch, we had 5 single stock futures, which were really a representation of the 5 most liquid companies that were trading in our spot market. And we also had 1 index future. When we began, all our contracts were actually fully cash settled. So that trend still actually continues. All our contracts that we currently hold in our market are cash settled. Having walked the journey through the first couple of years and also through the COVID period, we were able to expand our market by introducing a market maker. This came in 2021, and this was really able to fund and provide liquidity to retail investors. And we still have the fund currently active, so that created a very good boost towards the activity in our market. When we also began the market, we had 7 trading members out of a total of about 20 in our market. Currently, that figure stands at 9 trading members who are really dealing most of the activity in the market. We've also introduced, since then, 6 additional single stock futures and index futures contracts, and we expect to be having a couple of more coming into the market soon. So maybe to touch on to your question on some of the hurdles that we had to really jump through when we came into launching the market. The first one was really on investor education. Being a very new product in the market, there was not a lot of technical expertise to understand how to trade derivatives and what derivatives products are, how they work. So that really was quite a bit of a challenge. So what we really undertook was to do quite a bit of investor sensitization amongst the retail market and institutional investors on the use case and how trading single stock futures can also benefit them in their portfolio management. I think the other challenge that we had was really on a first mover sort of paradox, where a lot of investors came in asking the question of liquidity. For me to come into the market, there needs to be liquidity. But at the same time, liquidity is not coming into the market because everyone's waiting for it. So it was really a chicken or the egg situation, which I'm sure my colleague from the JSE will tell you it takes quite a bit of time to solve. So we solved that partially in 2021 to accommodate our retail market by having our market making fund. But on the larger scope of it, it is quite a long journey towards solving that problem. Thank you.
All right, thank you very much, Justice. I think that the challenges that you've mentioned are actually challenges that we're facing also here in Nigeria. And I can see Gabo was also nodding in agreement when you mentioned this. So just Gabo, Jesse's story, slightly different. You're a much older exchange, that the derivatives have been there much longer. Can you give us a brief history around the JSE derivatives market and what your current market structure and offerings are?
Okay. No problem. Thank you. And good morning to everyone. So we, the JSE derivatives actually started at SAFEX, which used to be called the South African Futures Exchange. The JSE then purchased or acquired SAFEX in 2001. But before then, SAFEX had obviously already started with the trading of some derivative instruments. Before SAFEX even started with trading of futures contracts, to be exact, they were actually initially initiated by RMB in 1986. And at the time, RMB acted as the exchange. Well, I guess for those particular instruments for the futures. So they acted as the exchange, they acted as the clearer, and they acted as the only market maker. But in 1998, about 21 banks and a few financial and other financial institutions came together to try and establish a formal exchange. So in 1990, SAFEX was formally licensed as an exchange, and before it was obviously taken over by or acquired by the JSE in 2001. So from about 1987, when the first futures contract on equity indices traded in South Africa, the first actual futures contract was actually introduced in South Africa in 1990. The first single stock futures contract was introduced in South Africa in 1999. And surprisingly, because globally, most futures contracts were first initiated on the agricultural markets. In South Africa, the first equity index future was initiated on or in the equity derivatives market versus in your commodities or agricultural derivatives market. So in terms of the structure, initially SAFEX only traded two asset classes, which is the equity derivatives as well as agricultural derivatives. So within the two asset classes, in the equity derivatives, they first introduced the futures and then moved on to the future style options. And then the agricultural derivatives started with the options before they sort of moved onwards to trade other sort of derivatives. And then in terms of the current structure, the JSE derivatives current structure, we offer 4 asset classes. So which is the equity derivatives, we offer currency derivatives, we offer interest rate derivatives, as well as commodity derivatives. So within commodity derivatives, we've got like your soft commodities as well as your hard commodities. And then in terms of some of the challenges that we're experiencing, I'll agree with, what Justice was saying right now. Our biggest challenge is liquidity. We have tried in the past a couple of market making schemes, like introducing market making schemes, trying to force market participants to trade, say if you're trading a certain volume, sort of force them to trade on screen. But that backfired. And ultimately what happened is that most of them then moved away from the on-screen trading, and most of them went OTC. So at inception of this product, it used to be the most popular product on exchange, more popular than our index futures as well as our index options. But now it's third. I think we do about 420 billion year to date. We've done 420 billion, give or take, year to date in single stock futures. While our index futures we've already done over 1 trillion in terms of value trade. So yeah, so we had that exodus from the exchange traded market into the OTC market because of that. And also another challenge, I guess, because we offer ECFDs, so exchange traded CFDs, and I know our OTC market also offers CFDs. So some of our clients, instead of trading the single stock future on exchange, they'll opt for trading the ECFD either on exchange, but more often than not, the OTC version of the CFD, because it's very similar to a single stock future. And then the last challenge that I wanted to mention is that we've been told that our single stock futures are quite expensive from a trading cost perspective. We charge about 0.63 bips, and we charge on value trade on screen, and we charge more off screen to try and entice the market participants to trade on screen because of the cheaper fees. But we've been told that if you take into account the trading costs as well as your margins, your initial margin that they pay for this, and the current sort of interest rate environment in South Africa, where interest rates have just been increasing, it is said to be currently unprofitable to trade single stock futures on the exchange.
Oh, okay. Thank you very much for that, Gab. I think given that perspective, maybe Justice, if we have an idea when if we move over to the participants in the market, how do you see the split between institutional and retail participants currently in your market, and how do you encourage both to participate?
At the moment, our market is almost 100% retail. Again, it just comes back again to the paradox of where the liquidity is supposed to come from. So as much as the market making fund that we have caters to retail, realistically, it cannot support the exposure for institutional investors. So one thing that we have been looking to be able to address that, which also ties back into some of the product offering that we have, is when we launched the market, we had a select number of the single stock futures and index futures that, let's be honest, were determined by the exchange. We went for what we thought the investors would want. So ideally, the tact or the plan has sort of changed to be able to explore more market-led products. So we have been engaging with a lot of our stakeholders, our trading members, and some of the investors to really be the ones to tell us what kind of products they want us to be able to introduce to them. That way, when we approach them and ask them why you're not trading, then the answer is not really the products, because you've delivered really what they are looking to invest. So I think that really is one of the key mechanisms that we will be looking to address that. For the retail side, which I mentioned, market is almost 100% retail. The biggest win for that segment has been on the cost of entry compared to buying the underlying security. So our margins on average are at about 13% of the underlying. So that is very attractive. The other thing that we also, I think we all need to be cognizant, even in our markets, especially with Africa, is with the risk appetite of the investors of the retail space. I say this because when we look at the flow of the volume of money that's going into products that we may not consider them competitors, but they are our competitors, is, for example, sports betting. I know we all see all the ads on TV all the time. So you have to understand that the risk appetite for the retail space is very high. So being able to create and structure products that are able to suit that need is also very good. We've also seen a very big uptake from FX brokers across the continent. So again, the investor education side is very important for us to be able to really deliver valuable exchange to the retail investors. Thanks.
Thank you, Justice, for that. And Gabo, obviously, I think maybe just very briefly, the split between international and retail, is it similar to Kenya? I assume it's slightly more on the institutional side.
Yes. So it is quite different from what Kenya's been seeing, and would love to have the large retail participants in our market, but unfortunately, right at the moment, it's not the case. So our biggest players in derivatives as a whole are not just single stock futures. It's our institutional clients, and our institutional clients consist of both local and international players. I guess the complication or the challenges from a retail perspective is exactly what Justice was saying earlier on, the lack of education. So we still have a lot of retail clients that have, said to us that they don't understand what derivatives are. They don't understand what a future is, how it works and all of that. So most of them are quite reluctant to play in that space. What we've seen is that those that do play in the financial market space will prefer to play in the spot cash, the spot market, spot equities market, by investing in cash, etc., but nothing any complicated than that. Yeah.
Just very briefly, let's just really touch around the technology and risk management infrastructure. So, what does the JSE have in place to ensure a transparent and vibrant market right now around the risk management?
Okay. So, let me start with the trading. So currently we've got a system called MIT, it's called Millennium IT. You might have been aware a couple of years ago in 2019, when I first actually joined the JSE, they were on a system called Neutron/Nucleus, and they had been on that system for years. I think probably a couple of years, maybe five to 10 years since that moved away from the open outcry system. And so apparently, so that's before my time, but it was a little bit slow. It gotten a little bit inefficient over the years. So then in 2019, they introduced what they call MIT Millennium IT. It is a system by LSE. It's solely a trading system where you can book trades, execute. So it allows for on-screen trading. It allows for off-screen trading. It allows for late trades. Those kind of functionalities that are being used globally. So it allows for all of that. And then we've got a separate sort of risk management system where clearing and settlement happens, which is called the RTC system. It's a system by NASDAQ, where all of our clearing and settlement happens. So two separate systems, where the one is just for trade and execution, and the other one is for more post-trade activities and risk management, etc. So it'll do margin calculations, IM calculations. It also calculates for variation margins, etc. So anything post-trade will happen in that RTC system, and anything trade execution related will happen in the MIT system.
Thank you very much. I think we're a little bit behind time, but just to round out Justice, what does the future really hold for the NSE in terms of derivatives, and maybe that Nigeria can take a cue from? What are your future plans for your derivatives market?
Thanks. Well, the future plans is just to really find our answer to the liquidity challenge. As I mentioned before, we have taken really a direction really to have the market more market-led. So having more activity from our trading members, capacity building amongst the trading members, because really, if they are the biggest sellers of the market, they are the biggest contributors to the market. So having more engagements with the trading members, encouraging them to be also become market makers. We also allow our trading members to have prop accounts that they can be able to trade on. So extending that liquidity towards their own clients, I think is one of the biggest drivers. We've also engaged with a lot of international players to be able to really bring in that liquidity that they're looking for. As I mentioned with our first mover paradox that we usually face here, our local institutions are a bit reluctant to be able to trade. But if we have foreign investors coming to trade in the market, then naturally they'd be more they'd become a bit more curious towards moving into that space. Maybe as a parting shot for lessons that you can learn from, I think is ensuring accessibility to the market for both institutional and retail investors. By giving them access to that risk to be able to make that own investment decision becomes a very key part. So providing the technology that allows retail investors to be able to open accounts, trade, and be able to really enjoy their profits or gains from that within a short period of time, I think would really drive that participation from the retail space. So thanks.
Thank you very much, Justice. Gabo, just 30 seconds, 1 minute. Anything you want to add in closing?
Yeah, just in closing, just some of the things that we are trying to push on our end that I think can be beneficial for this webinar. So most of our clients are European, and we are trying to tap into the US sort of investor space. So we are trying to get CFTC approval for some of our indices, DCAP to be specific, as well as streamline the liquidity in our market. We feel like we've got too many indices, so we're trying to harmonize our indices, have one or two major indices where the market can just pump the liquidity into that space, just to try and make our market a little bit more efficient and obviously liquid. And yeah, that's about it from my end.
Great. Thank you very much, Gabo, and Justice for the insight you've given us. I think there are a lot of lessons that we can learn from the two of you. And thank you very much for your time. I'd just like to add, I know a question has been asked about retail participants in the market. So we do have 6 trading license holders that retail participants can engage to gain access to the market. So we have APT Securities, PAC Securities, RMB Stockbrokers Nigeria. We have Cardinal Stone, Stanbic IBTC, and Meristem. So you can engage any of these brokers and they'll give you more information on participating in the market. That's all from me, Wale. Thank you very much. Thank you, Justice and Gabo again. Thank you.
Thank you very much.
Thank you very much, Chidima, Justice Gabo. Really, really insightful conversation there about what's been going on elsewhere and what we can anticipate as we continue to develop the markets over here in Nigeria. We're now going to move on to a panel session. And I do see that we have quite a number of questions come through, and I promise that we'll get through to the Q&A field shortly. But we would like to now proceed to a panel session where we'll have our panelists discuss the role of market participants in building a sustainable derivatives market in Nigeria. And to moderate that session, I'd like to now invite General Counsel and Company Secretary at NG Clearing Limited, Ms. Franca Egwekwe. Franca, it's over to you.
Thank you very much. Good morning. Good morning, everyone. Thank you for having me here. I will be moderating the session on the role of market participants in building a sustainable derivatives market in Nigeria. And very quickly, I see we're now becoming mindful of time. I will just introduce the panelists and then we can go straight into the panel session. So the first we have here is Mr. John Abazwe. Mr. John Abazwe is the head of Investment Monitoring Unit at the Pension Commission of Nigeria. That's the regulatory agency for the pension industry. We have Mr. Abbas Abdul Kadir. Mr. Abbas is the Director of Registration, Exchange, Market Infrastructure and Innovation Department at the Securities and Exchange Commission, Nigeria, of course. And we have Mr. Ike Imokwede, who is President of the Fund Manager Association of Nigeria. That's a market participant in the capital market. We have Mr. Biodun Adebimpe, who is the President of the Association of Asset Custodians of Nigeria. And last but not the least, we have Mr. Oguche Agoda, who is the Chief Executive Officer of the Pension Funds Operators Association in Nigeria. That's the PENOP. So yes, I am particularly excited about this session because, as you can see, the panelists are experts that have been drawn, from different segments of the key stakeholder groups in the important value chain, on the subject matter that we'll be talking about today in the Nigerian capital market. So it will be interesting to hear them share their perspectives on the subject. And of course, I strongly believe that that would spice up the session. So very quickly, we're much aware that we have limited time, so I'll crave the indulgence of the participants or the panelists, to just go straight to the point and let's try as much as possible to maximize the time that we have here optimally. So I think that for in delving into the matter, the subject matter for today, I'll start with Mr. John Abazwe, who, like I said, is the head of investment monitoring at PENCOM. So, Mr. John, you are the regulator of the pensions industry in Nigeria. And like we all know, in order to build a sustainable derivatives market, in our country, the involvement of institutional investors, like pension funds, is very, very crucial, particularly in light of business. Can you hear me? Okay.
I can hear you.
Okay. So I was saying that in building a sustainable derivatives market in Nigeria, the involvement of institutional investors is very, very critical, especially in light of the Business Facilitation Act, which has just recently been enacted into law. And of course, we know that that act has opened up this type of instruments to pension funds administrators. And yeah. So given your role as the regulator of this industry, how do you perceive the readiness and interest of the pension fund administrators in participating in derivatives products, such as the single stock futures that are at the verge of being launched by the NGX today?
Yeah, thank you. Good morning, everyone. Thank you for having me. As a regulator, I will go straight to the point. As a regulator, we see, we recognize the potential benefit of the derivative, this product for the investment of pension fund asset. As a regulator, we believe that our pension fund asset can leverage on that product, but only for a risk management, not for speculative. Given the passage of Business Facilitation Act 2023, we are mindful of that. And what we have done so far is to look at We have started discussion and we have looked at security lending, which was also a hindrance. We have not able to look into that direction because of the provision in the Act for building using pension fund assets as collateral. We have taken that advantage to look into that direction to see how we can allow security lending as allowable investment tools. Yes, derivative, we are also looking at in that direction, but what we do at first is to first of all identify a new product in the market. When we identify a new product in the market, we try to understand how that product is operational in the market. Try to understand the architecture of that product. Try to build, understand the risk and the mitigants in place, building capacity and amending regulation accordingly to allow such a product to be allowable for investment operation comparison. So, going to the point, we are doing all those things right now. We have engaged many institutions. I think we have engaged NGX on this regard, as well as FMDQ, in trying to build capacity regarding these derivatives. And we also have engaged other institutions to try to understand this product. We believe when we understand this product well, build capacity, look at the risk associated to it, and put measures in place to mitigate the risk. We're able to amend our regulation to allow pension fund access to play. We understand that pension fund assets will bring liquidities to the market. We understand that. We understand it's going to also use as management tools, given the nature of the movement in the prices in the market today. So, as a regulator, we believe that it's something we can do, but we cannot do that without building the capacity. So we are looking into that area to allow the derivative products like SSF. When we do that, when we build capacity and understand the mitigants in place, we are amending the regulation according to allow that product.
All right, thank you very much, Mr. Abdullah. So we've had the perspective of the pension industry's regulator and how they are preparing to welcome these products that is about to be launched by the exchange. Now let's hear from the apex regulator of the Nigerian capital market, Mr. Abdulkadir. I call him my regulator. I think today I'll get the chance to regulate him for a few seconds, and after that I return the title to him. So, Mr. Abbas, now in your capacity and having the responsibility of, overseeing the registration and regulation of securities exchanges, the clearing houses, other market infrastructure providers in Nigeria, and of course, promoting innovation in the Nigerian capital market. We know that the SEC definitely will play a crucial role, right, in building the derivatives market. And we also know that the role of the regulator or regulatory bodies is very, very pivotal. So I would say that this will involve not just product development, but also market sensitization, efficient regulation, and investor protection. We've listened to the experiences from South Africa and Kenya. We've listened to how they have different stakeholders participating actively. The Kenyan market is kind of dominated by the retail side, while the South African is dominated by the institutional investor participation. In our own market, we would like to see both groups of stakeholders, actively participate. And we know that in order to achieve that, the role of the regulatory body will be very key. So how do you perceive the cooperation and collaboration between the Securities and Exchange Commission and the market participants in achieving the goal of building a sustainable derivatives market?
Thank you very much, Franca. Really, today, you have the chance to regulate the regulator. Good morning or good afternoon, everyone. Please, let me just commend NGS for inviting the SEC to be part of this important discourse. It's really important because for us as a regulator of the market, we view this asset class as a very important asset class that we need to have a very robust regulation. And I think this started way back 2019. That is when the SEC issued its own regulation. To your point, or to answer your question with respect to the collaboration that we expect to have, really the SEC has been collaborating with all the key stakeholders, in particular the exchanges, the CCPs that we have registered. We have actually registered 2 CCPs, and we're actually collaborating with them and with other key stakeholders as well, and other regulatory bodies. And that doesn't just end there. Because we feel this is a very important asset class, and we need to deepen our market by encouraging, the trading of this kind of, product. As you know, the Commission has approved almost 28 derivatives contracts, but we are still at the infant stage because there is no much traction if you watch the trend in the market. So what are we trying to do now? To continue to collaborate with other stakeholders in terms of advocacy, which is very key. Capacity building is another key element, and that goes around all the perspective. When we talk about capacity building, it's not just only for the regulatory bodies alone, but even for the market players and other stakeholders and the investors, really. And the Commission has been doing this, in modules. What we try to do, we start with ourselves as, regulators, and we'll collaborate with other regulatory agencies, even including other international regulators, to build that capacity. And the second approach is to approach other regulators locally, central bank, the PENCOM, NICOM, to be able to really see how we can be able to collaborate and to encourage, like PENOS, the engagement with PENOS, to encourage PFAs to invest in this kind of asset class. And to also hear from PENCOM, what are the kind of regulations that need to be tweaked to allow, PFAs, for instance, to trade in derivatives. So these are all encompassing strategy towards, deepening this segment of the market. Then again, apart from the capacity building that I mentioned, which we have already done, and now we even have another milestone of capacity building. We try to get, international, partners to get some certain grant to see how we can deepen our own capacity, develop our capacity. We believe it is after we have done that, we now have another approach of having our training institute, NCMI, to design courses on derivatives for our market players. Because one thing that we notice, at least I sit on the desk of registration, what we observe is that even the players that are coming to get license for derivatives traders or clearing members, which are the banks, the sponsor individual need to be trained specifically for derivatives. So these are the kind of collaboration that we're really going. It's actually ongoing, and we feel if we go in that way, we really make a very good traction in terms of deepening and collaborating with other, stakeholders to deepen our market further. Let me just stop here for now. Thank you.
Thank you very much, Mr. Abdul Kader. So I think we have heard a bit from the regulatory agencies and their perspectives on how, they are preparing for the launch of these products. We have also heard, about the readiness of their the industry that they regulate. I'm particularly happy about Mr. Abbas's view in terms of the collaboration across the key stakeholder groups and, being driven by the regulators. That's quite impressive and commendable. But now I think we may need to move on to the operator stakeholder group, just so that we can also get their views about their readiness, to take advantage of these products that is being innovated into the market. And of course, we all know that these stakeholder groups most of them are largely institutional. So I'll call them the warehouse of the monies that we're looking forward to being invested in these products. So on that note, I will call on Mr. Aguda, who is the CEO of PENOP, to share his own perspective. So Mr. Aguda, the question for you now is that in light of the opportunities that we have been told that the financial instruments like derivatives and in particular single stock futures offer, including serving as income generating assets, as well as a tool to hedge against macroeconomics risk such as inflation and the currency risk that we're currently experiencing today in Nigeria. So what would you, and of course, piggybacking from the points that Justus talked about, in their markets and how they have also used this to hedge against different risk exposures that they face. So in your capacity as the CEO of PENOP, what role do you see that single stock futures will be playing in the near future in the pension industry? Particularly as the industry becomes more and more competitive and pension funds begin to jostle to improve their investment returns.
Thanks, Franca, for that. Before I answer, I just want to quickly thank the NGX for putting this together and for bringing innovation to the market. It's something that PFAs have always wanted, to see a breadth of products and to see more depth in the market. So it's very well good. You're right to say that there's a lot of competition, jostling for clients, whether because of the transfer window or just trying to improve returns. So this the single stock futures or derivatives in general, it does provide an opportunity for pension funds to be able to increase their returns, and it's music to our ears. Just listening to all the speakers earlier, about doubling returns, and that's music to our ears. But I think what needs to happen is the right regulatory framework to be in place. Just jumping on what my regulator had said, which is just ensuring that the capacity building, which is using these derivatives more for risk management, return enhancement rather than speculation. I think that's one thing our regulator is always fixated on, not speculative, but more return enhancement and regulation. So it does play an important part, the single stock features in particular and derivatives in general. It's something the PFAs are looking forward to. I guess there just needs to be a bit more engagement. There needs to be more understanding. I'm also happy with what I heard from the CCP, just in terms of they being able to ensure failed trades are limited. That's also good for the market. So really, this is something that's is good for the market, something that is good for the PFAs and the contributors if we're able to increase their returns. What we now need to do is to see how we can limit the risks, and that comes by understanding capacity building, which SEC and PECOM have spoken about, engagement, and really just more engagement. We can move away from that engagement with the PFA community, which we are willing to facilitate and have been doing. Thank you, Franca.
All right, thank you very much for that perspective. I think it appears we're all aligned about the opportunities, the numerous opportunities, I would say, that abound in this space. It kind of ties in with also the presentation that was delivered by Gabriel, where he talked about all of the trading opportunities and the advantages, to leverage and to diversify investments and all of that. So I'm happy that it appears that we're all sharing the same sentiments, and that then tells us that we have a lot to tap into these products as they are being launched. So I'll go over to Mr. Ike Mokwede as I continue with the operator side of the stakeholder group. So Mr. Ike, you are the president of the Fund Managers Association of Nigeria. And as we know, fund managers play a crucial role in asset allocation and investment decisions. So considering that in an actively managed portfolio, stock and index futures tend to offer some important possibilities or opportunities for improving investment performance, how do you envision the integration of derivatives products such as single stock futures into fund portfolios, and what potential advantages does this offer to investors? I think you're muted, Mr. Ike.
Thank you. Sorry. Thank you again. And just not to espouse too much, but then thank you for the NGX for what they have done and what they've been doing around investor education. And thank you also for the SEC for what they're doing around putting in the right regulation and ensuring that we have best practices as we enter the derivatives market. All right, so with our capital markets, I mean, somewhat remaining shallow in terms of product development, despite efforts by all stakeholders, the derivative market is important because it gives an opportunity for fund managers in Nigeria to begin to look at how we can play into derivatives as well. You know, so I mean, things gain or reduce exposures to a certain market, sector, security, or target exposure to other target exposure more quickly and lowering transaction costs and also portfolio disruption. You know, we can then precisely target risk exposures, benefit from price differences between cash securities and related derivatives, gain access to markets in which transacting in cash securities is difficult, costly, or not possible, and of course also gain exposure to commodities such as an asset class which is subject to certain tax tests and so on and so forth. So for investors, unlike cash securities, derivatives can enable investors to purchase or sell exposures without committing cash in an amount equal to an economic exposure or a notional value of the position. And these derivatives and cash securities or traditional securities markets are becoming increasingly integrated everywhere. And so with the movement in one market quickly reflected in the other. So fund managers can use derivatives as an alternative to or a combination with cash securities. I hear people speaking to okay, so for instance, integrating derivative products such as stock index fixed futures into fund portfolios to enhance investment performance, and then also using us as a manner of allowing the retail market enjoy what the institutional market can, segments of the market can enjoy from derivatives. So we can use our expertise, research, insights, and what have you to help democratize the access to derivatives for the investing market.
Thank you very much, Mr. Agimokwede, for sharing that insightful perspective. I'll move very quickly to Mr. Biodun Adebimpe, who is the president of Association of Asset Custodians of Nigeria. Like I said, all of these experts representing the key institutions where we are looking to have all of the monies come into, these products, because you can hear all of them, have some sort of funds connotation to their names. So, Mr. Adebimpe, I think your question would really be for you to share your views on how you think that the role of asset custodians in supporting the growth and sustainability of the derivatives market in Nigeria would be, given the many opportunities that abound in this space, including the utilization of asset classes such as single stock futures to promote transactions like securities lending and similar transactions. If you recall, Farouk had mentioned the different opportunities that the product side would have to offer for the CCP to then take on for the clearing and settlement. And one of the things he mentioned was securities lending transactions. So in your role as, or your capacity as the president of Association of the Asset Custodians, how exactly do you think that you will leverage this asset class for such transactions?
Thanks so much, Franca, and good morning, everyone. I think speaking on behalf of custodians, I must say that custodians are very crucial. I think I can categorize custodians' roles in two categories. I can put it in two ways to say, number one, when it comes to that investor education, which I think is it's been like a recurring decimal, right? Almost everybody has spoken about investor education, even listening to to Justice from Kenya. Because custodians are also close to the investor, and whether you are a pension fund custodian, a non-pension fund custodian, you see that in the portfolio investment ecosystem, right? Custodians, we see it as the eyes and the ears of the investor in the market, and that's educating our clients as well as sharing market information with them. I think is one crucial role that custodians can play. I think next to that is when we talk about custodians, most times we do forget in Nigeria that custody is typically just one product of the many, capabilities that custodians or custodian banks do have. And that's why you see most custodian banks now are changing it from calling themselves just custody. You now have what they call either security services or global security solutions, which means that in addition to custody, you find derivatives clearing, as a key capability that's offered, by custodians. I mean, I work for Rand Merchant Bank, and when you look at an institution like Rand and some other custodians, especially those that have international affiliation, you realize that we've got experience, in other markets, whether it's in Kenya, whether it's in South Africa, where some of the Nigerian custodian banks, have operated as, derivative clearing member for decades. It shows that custodians can import, that knowledge, that they've got in other jurisdictions. So when you talk about educating the investors, I think custodians are very key in that space. I mean, because of time, I would just say, I think finally, offering that derivative clearing capability. I mean, when Farouk was speaking, he was talking about you need to have the trading members. Now, the trading members need to have general clearing members, right, who are banks, with balance sheets that meet the requirements. So actually, custodians need to expand our product offering to be able to provide, derivative clearing so that we can sign on trading members as part of the key touch points within the market. I think the last thing I will mention is also advocacy. I think the SEC has mentioned that also. Custodians who eventually become derivative clearing members, on behalf of trading members and also representing the portfolio investment community, will also be involved in advocating, right? Seeing how do we need to tweak the regulation, what more do the FMIs need to do, and all of that. So, I mean, in short, custodians are very key here, and if we're going to get this off the ground, custodians really need to, step on the, on the podium for this to happen. Thanks, Franca.
All right, thank you very, very much for that enlightening perspective from you. So I see that we're running very fast. Perhaps we can just, do one quick round and then try and wrap up very quickly. So I'll go back to our apex regulator in this market, Mr. Abbas Abdulkadir. In light of all of the views that have been shared by the different stakeholder groups, we would see that, everyone seems to be ready and just waiting for the launch to happen. So Mr. Abbas Abdulkadir, my question for you is for you to share some insights as to what regulatory frameworks and guidelines that the Securities and Exchange Commission has put in place to support the development of the derivatives market in light of the impending launch of single stock futures in Nigeria.
Thank you very much, Franca. So I think I earlier touched on that, but let me just briefly dwell on the regulation, which I mentioned. We issued this regulation in 2019, and the principal plank of the regulation really is to ensure that we protect the investors. So the SEC came up with this regulation. We take into account the risk management issues and even the effect on financial system stability of this kind of instrument. And of course, the issue around investor protection. So the rule was carefully crafted to prevent a kind of taking excessive leverage. And how did you, and we have a kind of mechanism that we put in place. Certain provisions were embedded in the rule, provision around leverage, margin, and collateral requirement. These are all requirements that we put in the rule clearly to now ensure that we protect the would-be investors in the market. Because as a regulator, when you have a novel product, the first thing is to even understand that product, how it even works, and then come up with a kind of robust regulatory regime to now create that kind of confidence that there's really clear regulation. And of course, I think Farouk touched on the provision that we have, very copious provision about CCPs, the role of CCPs, the role of even the securities exchange. And if you look at that rule, we have clearly mandated that all exchange-traded derivatives and even the OTC standardized contracts has to be settled through CCP, because again, to prevent these systemic, issues or systemic, to prevent systemic effect if something will go wrong. So we try to make CCP to be very important, party in addition to the exchanges. And of course, the rule provided the exchanges where this instrument will be traded must ensure that this contract, even though SEC would approve the overall generic contract, but the contract, they must have mechanism in place that it would be resistant to any kind of passive manipulation. So all those are actually safety bars that were provided. And if I can just go further briefly about reporting obligation of the CCPs and even the exchanges where these instruments are traded. So we have those mechanisms, and it's still a kind of work in progress, trying to come up with other, safety bars, because the rules are made in such a way that when you start implementing the rules and you perceive that there are areas of concern or areas that you need to tweak, you can quickly amend the rule. And the way we make the rule, and everybody know, we make an initial draft, and then we expose it to the market. So we expect the marketplace to look at our own proposal. And that's how we even came up with that rule in 2019. By the time when they look at the proposal, they make their comment, we look at the comment, look at the merit of the comment, try to even liaise with other regulatory bodies, within and, intentionally, to be able to make it robust. And that's how we actually come up with this rule. So the point I'm making is, look, in terms of regulation, I can say the SEC is really ready and very supportive towards this kind of asset class. And we really need to see good traction, but with the safety bars that we put in place to ensure compliance and to ensure that the principal plank of regulation, which is investor protection, is actually adhered to at any given point in time. So that is actually what we try to do from our own perspective. Thank you.
All right, thank you very much, Mr. Abbas Abdulkadir, for giving us the comfort that the SEC has indeed laid down the long-awaited regulatory framework for these products to thrive. So I think still on the regulatory side, before now, we knew that there were lots of constraints or restrictions on the part of the pension fund industry to participate in this space. And then, like I mentioned earlier, the Business Facilitation Act has now kind of, relaxed those restrictions. So bearing that in mind, Mr. Abazua, would you also share your perspective on the regulatory guidelines that PENCOM has in place to ensure that pension fund investments align with the goal of, building of the derivatives market? In particular, what specific initiatives has PENCOM, put in place to promote the use of derivatives such as single stock futures by pension funds? Seems you're muted.
Oh, thank you, Franca. As of today, derivative is not allowable investment for pension fund assets. And like I said earlier, Whenever new product is there in the market, the role of the commission is to identify the product, try to understand it. We understand the benefit that a single stock market will provide to pension funders, particularly in the area of using it as risk management tools. We understand that. So what we are doing is trying to look at how it's going to be operational in the market. Look at how comfort we are going to be with it, vis-a-vis the regulation around it. I listened to my colleague from SEE, what he said about the regulation. So we like to see what they have in the regulation. We like to see the mechanism to safeguard the pension fund. All are aware that the major objective of the pension fund is to invest in a manner that will guarantee safety. So for us here, we believe it's a good product. However, we must understand how it's being done in the market. We must build capacity. We must now come back and amend our regulation to allow it as one of the instruments fund can play with. So we are watching the market, and we believe all this can be achieved through our collaborative effort. We have open door policy in Ghana, and we hope to get more of this from NGX, from SEC, to understand how we can build capacity around it and allow pension fund assets to play in this very market. For us now, just to amend the regulation. There's no other law prohibiting pension fund asset from investing in this regulation. Only for us to understand and amend our regulation accordingly.
Thank you very much, Mr. Abazua. I am afraid we are very far behind time, and we may just have to take some questions, and perhaps in the course of the Q&A session, we'll still have other panelists, chime in their views. So I will, just 1 second, let me see, there are a whole lot of questions here. And
yeah. Thank you, Franca. Actually, I was going to sift through the Q&A and then perhaps just share the one or two of the questions that I think we can take before we wrap today. The first one perhaps is, what are the NGX plans to improve participation and liquidity and trading in futures, which is currently very low? So perhaps Chidima, do you have any perspective on that?
Okay, thank you, Wale, for that question. So what we're doing is that we're actually trying to engage the operators that will help us. That's basically the intermediaries, the trading license holders, to participate more in the market and increase the number of trading license holders so investors can have access to the product. Investor education is something that we take very seriously as well. I think part of the liquidity issues we have is around understanding of the product that would allow investors to participate. So things that we're doing here, this is for the public workshop that we're holding. We engage each of the stakeholder groups individually for capacity building, engage the regulators and other stakeholders. I think what's important here, and maybe it's a words to put out to people on the call, is around, I think both Justice and Gabo mentioned this first mover issue, basically the chicken and the egg. And so really it's a feed out to the market participants to kind of take more interest in the product. And then once we get the market rolling there, I think the product should seem to roll out seamlessly. So another thing we're doing is also increasing the basket of securities we have with derivatives. Like we said, we're introducing single stock futures. I think these are instruments that will be better traded than the index futures. Kenya, Justice didn't really have time to give the statistics, but you'll find in other markets, single stock futures trade better than index futures. And for that reason, we're introducing single stock futures to the market. So those are a few things we're looking at. Justice also mentioned market making. It's something that has come up. Again, this is something we're a facilitator, we provide a platform. We can't do this on our own. So something we're going to engage trading license holders on as well in terms of market making. Thank you.
Thank you very much. If I can bring back Olumide Odediro, there's a question here which I think perhaps you can speak to. Are there any specific tax implications or regulatory considerations when trading single stock futures in Nigeria? And the second question, which I thought perhaps is best suited for you, what resources and tools are available for investors to analyze and research single stock futures effectively? Would you like to chime in on that?
Yeah, okay. So can you hear me and see me?
Yes, loud and clear.
Okay. So the first question was tax implications. Again, different jurisdictions and different type of margin type products offer different things. I think we heard one of the speakers talk about CFDs that, you know, as taking volume away from the single stock future markets. Maybe, and part of that could be the tax implications around futures and the beneficial gains and rights people get when they're in those markets. So not all type of margin type products offer you tax levies. So I'm not 100% sure in terms of how we would treat futures, single future contracts, but in some jurisdictions, tax implications are there, and that has to be taken account to. The way some of those things work is they kind of treat futures contract tax and split it into long-term and short-term derivative type trading. So short-term tax implications for, I think, 40% and 60% for long. So they say 60% of your futures trading gains is treated as long-term investments, and they tax it accordingly for long-term investments, and then 40% for the short-term nature. So don't quote me on this. That's generally, you know, how I've seen it come across. In terms of education, this is where, you know, this is part of the whole process. We have to build capacity, build knowledge, get a framework that people can start understanding the basics first. It will depend on what we offer as a market and each individual institution own capability and capacity to train the individuals, because this market is individually driven. So for me to have a cohesive and productive conversation about derivatives, the language I'm speaking has to be understood by the person I'm communicating it to. So I can refer you to many places you can learn about derivatives and markets in general. But I think for it to come together as a whole, we have to have a central hub or central where there is a one-stop shop for this education resource that is more relevant for our market. Build easy communication pathways that way. So right now, I don't want to tell you where to go because I'm sure there's work that Chi will communicate later in the future.
Got it. Well, I imagine that the NGX and all other collaborators and NG Clearing, everyone will come together to help to address investor education. There's a question here about what happens to the initial margin at the end of a futures contract. Are they returns to the investor? Perhaps we can take this back to Mr. Oriagba. Do you have any perspective on that question, please?
Can you hear me?
Yes, loud and clear.
Right. Yes. So you have your, yeah, in a nutshell, yes, it gets returned back to you. Your initial margin is, while the trade is open, you have your initial margin, which basically you have your initial margin plus your ELM, which sort of make your maintenance margin, which is the minimum amount of money that you need to have on your account. On a day-to-day basis, your position is marked to market, and you have what you call a variation margin. Your variation margin is effectively your loss or profit from the previous day. On closing your position, all your margins, net of any losses, are returned to you.
Got it. Another question for you. What exactly do clearing members do and how do they make their money?
Well, what we, if I have to tell you what we do, then I've just wasted the last hour on the show.
No, I thought actually maybe I got this wrong, but I thought.
No, I'll tell you what we no, but seriously,
right?
How do we make our money? We charge a fee.
The clearing members charge a fee.
Yeah, it's part of your.
At what stage? Just get a sense of
0.0
every time there's a trade. Okay.
On every trade, I think it's our fees are about 0.04%. So a minute amount. I mean, derivatives are a volume game. Like, you heard earlier on 84 billion contracts. So 0.04% of the notional amount on any, at the outset of a trade. And then you have your, obviously, exchange fees, but our fee is 0.04%. It's minute because we're relying on volume.
All right, thank you very much. Let me go to Mr. Abbas now. Mr. Abbas, there's a question here about, will the SEC's asset allocations be modified to include this derivative as an acceptable asset class for applicable funds?
Okay, thanks, Wale. So for now, for what we have in the framework actually doesn't provide that for traditional funds. However, for specialized funds, the Commission do allow a certain portion of the fund asset to be invested in derivatives. So that's how that's what we have for now. And as I said, this is a new asset class. As we proceed, if there is need for it to be clearly provided, even for the traditional funds, that is something that could be considered by the SEC. But at least for now, this is the situation. So for specialized fund, yes, the Commission do allow just a percentage to be invested in derivatives. Thank you.
All right, thank you very much. Because our time is far spent, I'm unable to take more questions, but I would like to appeal to all our speakers, panelists, if you can just take a look at the Q&A field and perhaps respond to some of the questions that you are able to before we wrap. We'll be most grateful for that. So on that note, I'd like to now invite Chidima to deliver some closing remarks as we round things up.
All right, well, not to take your time, just to say something, just in response to the SEC, just so that they know, because I've spoken to the fact that we are getting, so look, fund managers we are increasing our preparedness to utilize derivatives in instruments for portfolio optimization. And of course, in doing that, we have to look at the robustness of our risk, which we are doing, robustness of our risk frameworks, risk management frameworks, our policies, our processes to ensure that we can meet the requirements and the fears of the Commission. Also, I believe that funds are a very good way in which to help to create opportunities for the retail market to come into this. Thank you.
Thank you very much for that. And so all points taken thus far, and we certainly look forward to a very vibrant market as this gets started. I'd like to now yield to Chidima to give some closing thoughts.
Thank you very much, Wole. Distinguished ladies and gentlemen, thank you for participating in this very educative event. Today's webinar is a direct expression of our commitment to market development. And it is our hope that you emerge from this workshop with an in-depth understanding of single stock futures market, the stakeholders, and the players. We are truly delighted at the deliberations and contributions from our various stakeholders during this event. And your participation is a testament to the interest you have continuously demonstrated towards the development of exchange-traded derivatives market in Nigeria. I strongly urge market intermediaries to take from here the applicable knowledge to serve the interests of their clients who are potential users of exchange-traded derivative products. I would like to reiterate the exchange is poised to develop a thriving exchange-traded derivatives market in Nigeria. Therefore, we encourage all participants to trade the index futures contracts currently listed on the NGX platform as we await the imminent launch of single stock futures. We have the right regulatory environment, the technology infrastructure in place to support the integrity of this market. The exchange will continue to leverage relationships and partnerships to organize various derivatives workshops, webinars, and conferences to enhance market education and awareness for this product. These capacity building activities will continue as adequate knowledge of these instruments is imperative for anyone who engages in the derivatives market business. Once again, I appreciate our sponsors, APT Securities and Funds Limited, PAC Securities Limited, and RMB Nigeria Stockbrokers, as well as our speakers today, Mr. Gabriel Olumide Odediran and Mr. Farouk Oreagba, for their insights. Lastly, on behalf of Board of Directors, management, and staff of NGX, we'd like to thank all our stakeholders and other participants in this webinar, including NG Clearing, the SEC, PENCOM, the AACN, PENOP, and the Fund Managers Association. Thank you all for participating in this workshop. I thank you and enjoy the rest of the day.
Thank you very much, Chidima, and thank you again to all our participants and of course our sponsors and other stakeholders that made this happen, collaborated with the NGX to continue the conversation around single stock futures. And we certainly look forward to the launch of this very important product, which I mentioned earlier, can help in not necessarily predicting the future, but certainly managing it. Thank you again to everyone for joining us for this, and we look forward to having you at the next event. Have a great day.
Thank you. Cheers.